Good morning and good afternoon, everyone. I know you're sitting there waiting for us to launch into today's webinar. My name is Kevin Kehoe, and at the present moment, Greg Herring, who is my co-presenter today and actually the lead presenter, is experiencing some technical problems, Greg, I think. So if you are patient and give us a few minutes, we will get the seminar and the webinar going. I could probably give you a little bit of background and groundwork on what we're going to do today as Greg gets his computer stuff sorted out. A number of things. Number one, we're about 45 to 50 minutes today. It's the first of two. Greg and I have spoken about this, and it's likely we may do a third or a fourth, depending upon feedback we get from you all, but we thank you for attending. I'm Kevin Kehoe, founder of Aspire Software. Greg is a partner to Aspire. And Greg works with a lot of the Aspire clients on things like pricing and reporting, etc. And we're going to walk through today a process about pricing, right? How you establish pricing. And there are several ways to do this. So we're going to give you a way this week. On our next go around, we'll dive a little bit deeper and drill into some of the nuances on that, as well as discuss some other related or alternative methods to doing that. I mean, ultimately, we would want to also share with you some of the benchmark numbers on this as we get to the session too. At the end, Sid on our team, Patrick on our team, will provide you information about signing up for the second part two of this webinar, and also give you any instructions as to getting information on the recording, any of the downloads, etc. we're going to provide you today. Greg, it sounds like you're there.
I am here.
Great. So I gave a little of an introduction, Greg, to who you are, and maybe just to complete all that, right? The lead into this and why Greg and I decided to do this first one as well as the next and potentially additional ones is profits start at pricing, right? If you get that wrong, production gets punished, margins get hammered. And so there is a right way to do it, and there is a right price. And as Greg and I will talk about over the next couple of sessions, right, that price is more than a pure financial calculation. There are market things that we need to take into account to also do that. But there's an essential starting point, right, Greg? And you got to know your cost. And if you know your cost and you work through the process and you keep on top of it, right, you'll get to the right pricing. So with that, Greg, I think I'll let you take off and start the program.
All right. Thank you, Kevin. It's great to be here with you and the Aspire team. Let me start with a little bit of background about myself. I was trained in accounting, worked for an accounting firm, Pricewaterhouse, for 6 years, and worked for a public company as a controller and CFO for a number of years. Worked for a startup, learned lots of things in all those processes. Certainly we had some failures along the way and learned a lot about failure, and also did a lot of thinking about success. And I want to start by defining how the Herring Group defines success, because that flows into our methods, and it certainly flows into the discussion that we're having this morning on pricing. So we define success certainly as greater profit margins. Shouldn't be a surprise, because we are financial people. We think in terms of numbers. We think numbers tell a story. And greater profit margin is certainly part of the goal. Greater profit margin is the excess of revenue over expense, and that number is then divided by revenue to come up with a percentage. That's the margin. But life is about more than just profit. Profit is necessary and good, but we also define success as greater life margin. And greater life margin is the excess of time and energy that people have. And a lot of people, especially business owners, don't have a lot of excess of time and energy. So the great thing about the process that we put in place is that process results in both greater profit margin and greater life margin. And I'm going to explain a little bit about that in just a moment. And certainly pricing is as Kevin said, is very important for profit margin and life margin. So we define success as our clients succeeding in those two areas. If our clients are not succeeding in those areas, then we're not succeeding. Now, when we implement this process, and as owners get greater profit margin, greater life margin, there's two transitions that happen. One is a transition in decision making. And I stole this from one of my great clients. He said, Greg, what we've done is we've gone from guess and wait, where we make decisions based upon gut instincts and what we think we know, and we wait to see if those decisions are correct, right? And we've gone to know and decide. And Aspire is what makes this possible. Aspire captures an enormous amount of data. And simply put, what we do at the Herring Group is we get that data. I think about it as mining for gold. We get that data and we put it in a format that people can use to make decisions. So the better that data is, the better the reports are, the more people that are trained to use those reports, guess what? The more life margin the owner has. The second transition that happens is we want owners going from managers to leaders. Management's all about getting tasks done. Leaders set culture, they set values, they set direction, they help determine strategy. And we want managers or owners to spend their time as leaders, not as managers, not getting crews going in the morning, not worried about the details. So we want to see that transition from management to leadership. And so we see that happening over a period of time. In this path to 12%, we see the owners managing less and leading more. Now, in this path to 12%, it's about 6 steps. And as we implement this with clients, we serve as consultants, right? We're bringing some expertise. But we also, and this is a surprise, I think, to a lot of clients, we also serve as a contractor, meaning we're actually doing some of the work. We're not just telling them what to do, we're doing some of the work for them. And the things that we're sharing this morning are part of that work that we do for our clients, and you certainly can do it yourself as well. And then the last way that we serve is as a coach, right? It can be lonely as an owner or a CEO, and we bring encouragement to help those owners and CEOs, branch managers, general managers to pursue the goals that they've set out. So the 6 steps, first one is alignment, and we're going to talk about that next week. One of those parts of that, alignment, where we calculate the rate and load, labor rate and burden. Important in getting alignment. Now, what is alignment? Alignment is very simple. It means that the estimates in Aspire or whatever software you're using tie to your actuals. And your actuals in your software system, like Aspire, tie to QuickBooks. I have many clients who say, Greg, why are my QuickBooks gross margins less than what I think they're going to be when I look in my software system? Now, Aspire makes this really easy. We add in a few other tips and tricks to make sure it's clean and that you have this great alignment in your numbers. So no matter where you're going, whether you're looking at estimates or you're looking at actuals or you're looking at gross margins in Aspire, revenue and direct expenses in Aspire, or in QuickBooks, they all line up. That's alignment. Labor hour management is pretty self-explanatory. About half our companies, when they become clients, don't have a plan to manage labor hours, either daily or weekly, so we help them put a plan like that in place. Profit model formulation, we're going to do a lot on that today. That's where we look at historical numbers and calculate markups and target net margins. So I'm going to show you exactly how we do that today, and you can do it yourself as well. The one part of pricing that we're not going to talk about is renewal pricing. So that's part of portfolio management, where you treat your customers and your services like a portfolio to be managed. And we're not going to talk about renewal pricing. That is part of pricing, but we don't have time. And if there's interest, we can set up another webinar to do that. The fifth step is refining the business model. That's where we bring into place things like incentive plans, defining ideal customers, looking at service mix, and things like that. And the last step is the annual budget. It's last for a reason, but I won't bore you with that today. All those steps revolve around a very important kind of culture and set of practices in a company. And it's where the owner or the GM or branch manager exercises leadership, supported by a CFO type. There's regular meetings with good meeting practices, and there is good reporting. Reports have to not only be interesting, they need to be actionable, and we help our clients do that. And you can do that same work on your own if you so desire. We'll be talking about some of those reports today. So that's the path to 12%. Now, the goals of pricing calculations. Here's one that's not a goal. I'm pretty sure our pricing is good. Now, we did a survey question at the beginning, and I'm going to get the results here from my buddy Patrick here in just a moment to see how people answered. But when I was putting that survey together, I was thinking, well, maybe I should do this on a scale of 1 to 10. And I thought, that's ridiculous. Who wants to be a 7 on being pretty sure the pricing is going well, or is what you need or what you want, right? You can't be a 7. And with Aspire, you don't have to be a 7. You can be a 10. So we put the question in there as a yes/no question, and I'm curious as to the results here. So let's see. We had okay. So assuming the crews perform as estimated, are you confident that your pricing will cover your overhead and get to your desired profit margin? So we had 15 people answer that question. 80% said yes, they are. Awesome. That's what we need in this industry. 80% saying yes. So for those 80% that are saying yes, I'm confident, or maybe I shouldn't say that, I'm hopeful that they are market leading in terms of net profit margin. Market leading would be somewhere north of 10%. If they're not north of 10%, then they may be confident in their pricing, but they can definitely improve in their profitability. So we don't want to be pretty sure. The second one is we don't want owners spending, or even general managers spending a lot of time reviewing proposals. Beauty of a software system like Aspire is that proposals can just come out correct. Most of the time, they wouldn't need any review or adjustment, and that's where we want to get. I talked a little bit about this when I spoke about alignment. What we don't want is the gross margin in QuickBooks to be lower than I expected. You know, some of my friends say, Greg, you're always so negative, and I tell them, well, that's because all I see as a CFO are negative surprises. I never see any positive surprises. If they reach my desk, they're always negative. And this would be an example of a negative surprise. I don't like negative surprises, and so we work hard as CFOs to make sure that there are as few negative surprises as possible. And this is one that is not necessary. Aspire makes it easy for those things to match up, and it's not necessary to have your gross margin in QuickBooks be different than what you were expecting. So that's the goals, or really the non-goals of pricing. Now, there's some common problems here. The failure to anticipate labor rate changes, right? We live in an environment where wage inflation is the norm. Incorrect labor burden. A lot of my clients have labor burden calculated incorrectly, and it's mainly about what needs to be included and what needs to be excluded. We'll talk about both of those next week. Inaccurate knowledge of overhead costs by division. We recommend that people do a full income statement, not in QuickBooks, but a full income statement for each division. So income statement down to net margin for irrigation, for enhancements, for maintenance, for construction, for snow, and allocate those overhead costs by division. There's always some surprises there, and those surprises mean that we can make simple alterations to the business strategy and become more profitable. Confusing markups and margins, right? This is one that I struggle with, frankly, at times, right? Is keeping that math straight. Those terms are not synonymous. They're not the same. So if you mark something up 25%, you do not have a 25% margin. You have a 20% margin. Take $100, mark it up 25% to 125. Take the 125, subtract the 100, and you got 25 left. Take the 25 divided by 125, and you got 20% as the margin. The money bag does not work. The money bag math does not work. Aspire has a great tool called the money bag that helps you set pricing. You can set it at very granular levels. And if that money bag, we see frequently where the money bag math does not work. And if you've had that problem or you think you might have that problem, I've got the perfect tool for you today that we will get to you. We'll walk through it with you to show you how to use it. That has all the formulas you need to know, not to guess, but to know whether your money bag math is working. And then the last one is not pricing services strategically. A lot of companies have to price maintenance with a net margin of 0 after fully allocating overhead to maintenance, and they're making their money on enhancements and irrigation. And if those divisions do not have strategic pricing, then they're not going to be as profitable as they should. Now, these are all common problems. It's why the industry's average profitability is about 4.6% in my last benchmark report, and why it's not at 10 to 12%. So, all right. So let's just talk about the cost of those mistakes. I'm going to turn away from the camera here for just a minute so I can see the screen that you're seeing. These are the costs that are going to be necessary based upon your historical numbers, and we're going to show you those how to derive this information, some this week and some next week. But you'll see that you need a wage rate. Your estimated wage rate is $17.75. Your labor burden is 22% and change. Your markups that you need to recover overhead are 90%, and your target net margin is 12%. Now, Aspire, if this is nomenclature best, that's customized for Aspire, it might be slightly different with your software program. So Aspire, to determine price, Aspire uses both the markup and the target margin to determine the price. So this is what you need. Patrick, would you click on that plus there? Okay, so apologize for the technical difficulties. Nothing like your computer crashing right before a presentation. All right, so the revenue then would be $46.95 for that hour of labor. So we're just doing 1 hour of labor to simplify the illustration here. The actual direct labor cost would be $21.74. That's the wage rate and the burden. You're going to recover $19.57 of overhead, and your net profit is going to be $5.63 on that hour of labor, and your net margin is going to be 12%. Now, let's say that you are going to miss out on, you forgot about inflation. So Patrick, if you go down to line 7 and click on that plus. So let's say we forgot to factor in inflation for next year's proposals. So instead we used our current wage rate of $16.75. Labor burden's the same, markup's the same, and our target net margin's the same. We just messed up on the wage rate. So the actual results then, we're going to price that hour of labor at $44.29 instead of $46.95. Now, our cost didn't change, so column H, $21.74 is still there. And the amount of overhead that we need to recover for each hour of labor didn't change. So that's the $19.57. But what changed? Our revenue and our net profit, right? And our net margin at 6.7%. So we lost a little over 5 points of margin because we forgot about inflation. Now, why don't we click on line 7 again? All right, so what if we forgot about crew indirect labor, right? So some clients have indirect labor above the gross profit line, and the only way to get that into a job is to put it in burden. So that's why that burden was at 22.5%, but they forgot about that, and I've had this happen on more than once, and they calculated burden at 12%. So again, a big change in net margin. It goes from 12 to 3.8. Let's click on line 10, Patrick. So on line 10, we messed up on our markups. So our markup should have been 90%, and it was only 70%, 75%. So that we lost 7.5 points there, right? Because we still needed to recover 1957 of overhead, and we did. That meant that our markup generated a net margin of 4.5%. So why don't you click on line 13 there? And what if you happen to forget two things, inflation and indirect labor, right? So then your markup is negative 2%. So, or excuse me, your net margin is negative 2%. So that's a big shift. Now, sometimes the percentages are confusing, and we just need to look at dollars. So Patrick, if you click on that plus sign on column Q, they're the dollars. So if you're a $3 million company, or this is a $3 million division, you're going to lose $160,000 on the, if you forget about inflation. You're going to lose $250,000 if you forget about indirect shop time. It's up there in your direct cost. You're going to forget about, you're going to lose $230,000 if you mess up your markup calculation. And if you mess up both your labor and your burden, you're going to lose $420,000 on a $3 million either company or division. So we're talking big numbers here, and that's why it's important to get it right. And frankly, I think that's why the industry average is profitability is 4.6%, because it's not like rocket science difficult to get this right, but it is tedious difficult to get this right. And the unfortunate fact is, once it's right, it doesn't always stay right. It has to be adjusted periodically. So we, for our clients, we adjust these things periodically during the year. All right, we're going to switch back to the PowerPoint. Evan, you want to talk about the chart of accounts here and how that impacts pricing?
Yeah, absolutely, Greg. So I think one thing Greg is pointing out, or will point out, is that these calculations get incorrect because lack of attention, but also lack of consistent accounting. In other words, what is in the line item itself? What do we define direct labor as, direct materials, etc., right? What's indirect, what Greg referred to as above the line, right? The line is gross profit. Everything else, quote, below the line is considered overhead that has to be recovered. So when you build a software system, you have to make some decisions about the definitions of the accounts so that you know what goes where. And if you're clear on that, and by the way, a lot of people don't have the Aspire type of setup, right? So what's in those accounts could be different, which is going to affect the calculations. So for consistent purposes, right, we do it a certain way. And that certain way is as follows, right? Revenue, right? We track two types. That revenue is what you invoice, right? And what is earned. And what's earned is based on what's worked. What's worked is based on what's on the work order or the work ticket, right? Hours, materials, equipment rental, subs, and other. So the way that we define above the line direct labor, that is the pay rates of the guys and gals doing the work with their tax burden, right? So that 12% Greg showed you on the other slide is probably more typical of an Aspire burden. So that typically means it's just the payroll related taxes and deductions that come out. That's what goes in direct labor. It actually went to a job. Somewhere, someone on the crew mobile device start the job, end the job, right? Those hours at the rates of those people, that's direct labor, right? Other people might throw other things in that number, as Greg indicated. They're indirect labor, right? We separate that out, put it below the line. They may also put workers' comp in there, right? Above the line. Not saying you shouldn't, you're just saying that you got to be consistent with whatever approach you take. Direct materials then, fairly obviously, are those materials not bought and expensed to the P&L, but those materials actually that were on a PO or an inventory allocation, right, that got to a job. The same with equipment, the same with subs, right, all coming through the PO process in a system that puts them directly to a job that gets costed that way and ends up above the line. And then, of course, you have any other direct cost. So when you think about labor, right, from our point of view, most of labor above the line or all of it is direct to the job. It got charged, and it's the payroll tax burden that did it. The OT premium portion below the line, right, it ends up being an overhead. The indirect hours, shop time, etc., right, end up below the line. So my message, and I think part of what Greg is talking about here, is there are ways people do this. This is why it often becomes confusing looking at percentages. When people compare percentages, when they benchmark things, is they're not comparing exactly apples to apples stuff. So the message is, know what it is, be consistent what it is, so when you call things that they are, that you're actually calculating the right stuff. Is that helpful, Greg? So while Greg is waiting to rejoin us, there you are, right? This is the stuff that Aspire calls overhead, right? That gets turned into markups, and there's your margin. That sound good, Greg?
That sounds good. That sounds good. All right, so let's go to the key here, which is the center piece here, right? Is how much do we charge for each direct expense to recover overhead and create the operating profit? And that's the question that we're really going to answer right now. So we've got a poll question ready, and I'm going to ask Patrick to fire up that poll question. All right, so let me talk about how we determine overhead recovery. We use one way, as Kevin alluded to earlier, is to use the dollars approach, and we'll, if there's interest, I'm back to muted. Is to use dollars, and if we use dollars, we budget our dollars of revenue, direct costs, overhead costs, and preferably by division. The other way that we use, and we're going to demonstrate this morning, is reviewing historical costs, where each direct cost is a percentage of revenue. Each overhead cost category is a percentage of revenue. We do it by division, and we think it works a little faster, and it works well if the company is stable or growing. So there's 6 steps. Step 0 is kind of a curious step, so it's an optional step in terms of pricing. One is to clean up your chart of accounts. Kevin did a good job of talking to that, and the cleaner your chart of accounts is, the easier it is to see things. And so we often encourage people to get their charts of accounts cleaned up so that it looks like what we showed you on those previous slides. The second step is determining the wage rate, and we're going to do that next week, or excuse me, in 2 weeks. And the third step is, or the second step is determining the labor burden. And any cost in QuickBooks that's above the gross profit line and is not directly costed to the job should be in labor burden. If you don't want to include it in labor burden, then you need to move it below the line in QuickBooks. If it's above the line in QuickBooks, it goes to labor burden. If it's below the line in QuickBooks, it's recovered as overhead. It's a very, very, very important distinction. In fact, if you don't take anything away from today other than that, that would be a good thing to take away. Any cost above the line needs to be charged to a job, and if you can't charge it to a job, it needs to be in labor burden. Any cost below the line is recovered through overhead, the markups. So the third step is gathering your income statement data, and we're going to show you a model for that in just a moment. The ideal is to look at it for the last 36 to 60 months so that you can see trends. We like to look at data in the landscape industry on a trailing 12-month basis. So we'll look at that on a rolling basis every month, having 12 months in there and seeing what those percentages of revenue are and how they change over time. The fourth step is populating the spreadsheet, and I'm going to demonstrate that here in just a moment. The fifth step is determine the markups and the target net margin. And we'll show you how to do that in just a moment. And the sixth step is a step that won't be obvious, but it's a powerful tool for the leader of the company to use, and that's publishing the profit model, because it provides great clarity. And I'll show you the profit model in just a moment. Now, you're going to want these templates. You might, if you've got multiple screens, you might even want to get them right now so you can have them up on one screen and kind of follow along as I'm demonstrating live on the webinar. So you just go here, enter your name and email, click the link on the page after you enter your name and email, or click a link in an email that gets sent to you, and it'll take you to a download place, and you can download this these Excel templates. One file with. All right, so let me go ahead and orient you to this spreadsheet. You do that? So here's the top half of the chart of accounts, right? And these items are in Aspire. If you have Aspire, they're in your actuals and your estimates, and they're also in QuickBooks. And we want that gross profit number, in this case, a 520, to line up. So to use this spreadsheet, the red numbers are numbers that you can use, and you just put the numbers in. The percentages will be calculated for you, and then those percentages are used on the next tab that I'll take you to in just a moment. You also want to populate your overhead. Now, these are the items in yellow. They're not in Aspire, and these items are recovered. Their costs are recovered through markups. And then we get down to operating profit, and this is the profit that's created through the markups, and in Aspire it's created by setting the target net margin, which I'll demonstrate here in just a minute. So just using simple numbers here to illustrate. All right, so now when we get to the markup page, this is where we've tried to simplify things. This is step 5. So we're just carrying over the same information that we had before, but we're carrying over the percentages. Now, revenue mix, normally we do this by division and even down to service type. So Aspire lets you price by service type or by division. It also lets you price by branch if you want to change your pricing for branches. Now, the poll results said that 65% of the people do division income statements at least once a year, where they're taking they're allocating overhead down to the net margin. So that's a great thing. That's very important because it shows you where you're making money, which divisions are making more or less money than the other divisions. So revenue mix is simply the mix of the divisions, right? So this one, we're only showing one column, so it's only going to show up in one place. So you might have maintenance at 40%, enhancements at 15%, irrigation at 15%, that type of thing. And then that mix helps determine the profit model that we'll see in just a moment, how you're going to get to that 12% profit. So direct expenses, right? Those are just pulling those numbers over from the historical. And so down through line 23 is just a representation of your historical numbers that we had on the previous page. So then in setting your markups, we're going to use those percentages. So if we were going to alter, if we were doing this by division, we could alter the revenue mix, right? Any blue number here is a formula that can be altered to what we're planning to do for the next 12 months. These were our cost percentages, right? 62% of our costs were labor, 20% were direct materials, not revenue, percentage of revenue, but percentage of total direct cost. So we could alter those percentages if we think something's going to change there. Target gross margin, right? So we want to recover overhead. So our overhead for vehicles and equipment was running at 9%. Indirect labor was running 6%, other direct expenses 2%, 4%. So we've got 39 points of overhead that we need to recover. That's on line 44. The target net margin that we want is 12%. So that tells us that our gross margin, right, overhead to be recovered plus target net margin, the total of those two is our target gross margin, 51 points. Now, how do we do that? Well, in Aspire, we do that by setting markups for direct labor, direct materials, and you can actually set markups for each of these 3 items here on line 52, but I've simplified it here. So the yellow items with red numbers in them are the items that go into your Aspire money bag. Now, here's what doesn't always happen. And the reason it doesn't always happen is it has to be done a couple of times a year because some of these assumptions can change, right? Is that the math doesn't work. So you'll see this is a formula here on line 54. It is showing you that we're recovering the 39 points that we wanted to recover up here on line 44. And therefore, you know, it all checks. So the check number here on line 55 should be 0. But if I entered the wrong markup, like if I entered 75 here, the check number isn't going to work, right? And we only recovered 32% of revenue when we need to recover 39% of revenue. So guess what? Our profit isn't going to be 12%. And for you Aspire users, this is really important because just because you enter the 12 in there in the money bag as your target doesn't mean that that's what will be produced. You have to get the markups right as well. So if we switch that back to the 92, right, then we get to the 0 and everything is working. All right. Now there are a couple other things that you have to check. You got to check the market, right? We can put all the targets in there that we want, all the markups that we in there that we want, but if it doesn't work in terms of market pricing, then we have a problem, right? Now in this case, the current market labor rates we think is $46, and this markup and target net margin is only generating $44.81. So we've got some room to move up. So if we're going to move up, we want to start by moving up our target margin. So I'm going to change that to 13.5. See what happens there. All right, so now we see that my math isn't working because this number on 55, line 55, went to a negative. So I need to make a change here. So I'm going to change this to 97. That's a little too high, so I'm going to change it to 96. Still a little high. I'm going to change it to 95. And boom, we're at 0%. So now let's check our rate. We're at 46.30. We think we can do that. If we thought that we needed to be right at 46, then we'd have to chop this number down a little bit. And we chop that number down a little bit. And now we're at, we're not quite there. So we got to bring, because this, we're at -3 on line 55, -0.3. So we bring this line down a little bit. And we just keep iterating that way to get to the numbers that we want. We also have again, this is a spreadsheet that you can download. We also have this cost of materials, right? What's $100? What are we going to sell $100 of materials for? And based on these formulas, it would be $223.50, which would give us a 55% margin on materials. And what are we going to sell $100 of subs or equipment rental for? We're going to sell it for $136, which is a 26% margin. These numbers down here are used in the formulas, but you don't really need to pay attention to them. Any red numbers on these spreadsheets are designed to be changed. Any blue numbers can be changed, are formulas that can be changed. Black numbers you shouldn't change. I'm going to pause right there before we go to the profit model and see what questions that we have.
Hey, Greg, Kevin.
Yep.
I've been answering the questions as they go.
Awesome.
And one of them that's sitting out there is, how do you go about determining percent of admin by division, right? She says, I've always done it as a percent of revenue. I just want to make sure that that makes sense or something like that. So I think what I'm hearing is there's an allocation here about if I have divisions and I've got that overhead number, how much do I assign to maintenance versus construction versus irrigation, for example, okay?
That's a really good question. Now, I want to save some people a lot of time in the answer to this question. So I encounter clients that try and do all that in QuickBooks using classes. And I think it's an enormous amount of work for the accountants and bookkeepers, and it's not necessary. And if you need some help convincing your boss of that, shoot me an email and I'll send you something that you can forward to them. But the question's an important one. So let me just take one line item that's frequently found in G&A, and that would be employee-related expense. So it could be recruiting costs, it could be training time, it could be uniforms, all those employee-related expenses. If you allocate, let's say that you're a construction company and a maintenance company, and if you allocate those based on revenue, construction's going to get a lot of that cost. If you allocate those based upon labor, who's going to get more of that cost? Maintenance, right? Because maintenance is more labor intensive than construction, and construction has more materials. So that's an example where just a simple revenue allocation of that versus a labor allocation, direct labor allocation would generate significantly different results. And those different results could impact your pricing. They could impact your business strategy. So it's important to allocate those line items. We just do it in Excel a couple of times a year, but allocate those items based on what's driving the cost. Sometimes we'll get more complicated and we'll allocate, if someone's using a lot of subcontractors, we won't do a revenue allocation, we'll do a revenue less subcontractor cost allocation. So that's where financial expertise can really be helpful in helping you think through what's driving your costs.
Yeah, and I think maybe one other thing, Greg, and we could go in maybe more detail at the future one, but you know, all those costs, there's two reasons I think that matter, or two purposes around it. One is from an accounting point of view, I want to fairly charge a division with the cost that they incur. That's a good practice. I think the other piece, though, is regardless of that, that doesn't necessarily mean that might be the overhead that I use to calculate the price. In other words, I may want to over allocate for pricing reasons cost that may show up in construction into irrigation just because it can bear the cost because I want to be competitive. So I just think you have to separate the two. One's an accounting function. The other is really a pricing function of cost and market, if that helps.
Yeah, that's a great distinction. There's another good question up here, Kevin, that I don't think has been answered in that. Let me just read the question. For construction, the market pricing for materials varies greatly, i.e. you can mark up plants more than precast materials. What are best practices around this? Separate service types, guess the volume you will sell to each to make your budget, or just go with the same markups and forego potential market pricing? That's a really good question, and I get that question a lot. So by the nature of the question, I think that you're probably on Aspire with the use of the word service types. So the reality is you can't mark those materials up the same. And I'm going to defer to Kevin a little bit, maybe on some best practices within Aspire on how to do that. Aspire does give you the option to bring those standard markups down. It's just that when you set your markups on the money bag, if you're going to bring some down, you're going to have to bring others up. So typically, I recommend companies pricing at the higher markup, and just knowing that on some proposals, you're going to have to bring some of those prices down.
Yeah, I think some of it also, Greg, comes down to really, if you get into a little more detailed budgeting, you can't always predict what happens on a construction job, right? So you're trying to set markups in your system based on your budget with some projection of the actual mix of the work, right? Like I may have a certain budget set up that says I'm going to do 15% material and 10% that's going to be subcontractors, and then I've got labor costs, but your jobs you get that year don't turn out that way. And that's why I think there are some things in Aspire that when you do it, that can be done in the service pricing, or also done at a template level, right? So I can adjust in the template based on different mix of construction. So I can spend more time with Paul on that later, but that's a way of thinking about it.
All right, the next question says, I'm confused. What do you mean if the equipment remains on the job?
I got that one, Greg.
Oh, you got it? Okay.
Yep.
Okay. All right, so let me go back to the Excel spreadsheet. I'm going to click on the tab called Profit Model. And let me blow that up a little bit. So when most people look at their total performance, they're looking at something like this, right? We've got $8.5 million of revenue, 52% gross margin, going to recover 40 points of overhead, because that's what our overhead's been running, and we have a target net margin of 12. Now, the problem with that is that's interesting, it's accurate, but how do you act upon that? You don't. You can't. So I like to develop this profit model which shows the revenue mix there on line 6. So in this case, construction is 20% of our revenue, maintenance is 48, irrigation is 14, enhancement is 18. Each division has its own target margin, right? You can review that monthly. How are you doing against your target gross margin? You can review it for the last 12 months, how you're doing for your target gross margin. You've got overhead to be recovered. It's different in each division, just as we talked about. And then we've got a target net margin for each division. And then the blend, the magic here, if you look at the formula, it won't show on the screen, but the formula that's generating that 12% is basically multiplying the revenue mix on line 6 by the target net margin on line 12, and the weighted average is 12%. So all of a sudden, this document becomes a guide to the salespeople, why enhancements in irrigation need to be priced higher than maintenance. It becomes a guide for the production people in terms of what they have to produce. And hopefully it informs the selection of our customers, the profiling of our ideal customers. All right, with that, I'm gonna go back to the PowerPoint, and I'm gonna get through just the last 2 slides here. All right, so in 2 weeks, and you have to sign up for this webinar. Even if you signed up for the today's webinar, you're gonna have to sign up for the next one as well. There'll be some links going out that'll make that easy for you. And I think we've got a link in the chat box as well. But we'll cover the fundamental principles of pricing. This is some theory. I always like to talk about theory because every market's a little different, and the way that theory gets applied, I'm muted. The way that theory gets applied is different in every market. The narratives for pricing are, we'll talk about that. That's important for account managers to be equipped with good narratives for how pricing will, how we price things as they talk with clients. We'll talk about the nuts and bolts of calculating labor rates and calculating labor burden. So that's what we'll cover in 2 weeks. We've got a survey, and the survey is designed to inform us of what you might like us to cover, other than what we already have planned. So we can customize things based on what people want to hear. We can also have some, we may plan future webinars based upon what we hear. Want an Aspire demo? There's a link here if you're not on Aspire. It's a great piece of software, and you can go to this link for a demo, to request a demo. If you have any questions for me, there's my email address there. I'd be happy to answer any questions that you have that come out of this seminar. But we also have some time now for further questions. So anything else that you'd like to us to answer today?
Greg, I've been keeping up with some of the questions. There's nothing sitting out there right now. I think it would be great, though, on the survey, as we think about this topic and get feedback from the folks still on the call about additional stuff that you want to see and talk about. That might include examples of how you did a particular type of work, pricing, etc. One of the things that I think Greg and I are longer term into 2020, etc., is really looking at this concept of benchmarking. Right? Benchmarking can be quite tricky. It's tricky because things are different by market, region, and even type and mix of business. And then again, as I mentioned earlier, things are tricky because people don't account for things the same way. So it's hard to compare percentages, right, if things aren't consistent. So part of what we'd like to do next time, I think, with Greg and I also, is look at, Greg talked about percentages. We could talk a little bit about absolute dollar numbers to get to these rates. But I think one of the more important things that we were trying to get at was to start looking at how to simplify some of this by getting it consistent. And you know, software is an important part of it, right? One of the central tenets of any software system is, right, it provides pricing controls, right? It enables things to go out the door consistently, and probably more importantly, to get feedback on the performance of said things. So really simple example that many people have experienced just in this last year is, for example, maintenance contracts, right, that are either 2-year contracts or coming up for renewal. right? And the big factor, aside from overhead in relation to revenue changes, is just the labor rate, right? You're looking at, I'm achieving my hours, I'm right on target, yet my margins are lower. And that's critical information to have. I bid a job a certain way. Now, how do I go forward on future jobs, making sure I'm incorporating the latest labor rates that are in the system, right? And that kind of reporting is essential, right? Because if profit starts at the price, then knowing what the rates are and knowing what the recovery required is as you grow makes a huge, huge difference in having that information on a regular, simple kind of basis. You know, that ability, Greg, right, to know where my rate is versus what I bid, right? A lot of you are living with maintenance contracts that you bid at $15 that you're paying $16.50 for, right? There are solutions for that, certainly on the renewal, but also in the current state, right? Is what hours do I provide the crew, right? When I put a service ticket out there, can I manage that and control that either individually at the job level or at a route level basis, right? Where I'm pulling away or saving time on the route because of indirect cost, right? Drive time. So some of those things that Greg has talked about today and that we focus on when we build and manage and implement our own software, I think are critical, and going a little bit deeper the next time might shed some additional light. So to Greg's point, and Greg, I'll turn it back to you, is your feedback on what we talked about today in that survey helps direct and inform us about where we go and provide more information in detail next time. So Greg?
I just want to say thanks to everyone for participating, and we're delighted to get this information out there. I think Kevin and I have the same vision, and that is we want the landscape industry, the companies in the landscape industry, to be very profitable, because the owners have a lot on the line. They've worked hard over the years to create the company. They create employment for people. They beautify their communities, and we want them to get the profits that they deserve from that work. And we think with a little bit of software and a little bit of financial know-how, you can get those profits. And that's our vision, and that's why we do this. So,
yeah, and also I'm available if you want to email me also. Greg is a great place to start because he and I talk about all this stuff. So I would appreciate it if you got him to Greg, and Greg and I can get back to you.
All right, I think we're done.
Great, thanks. Appreciate everyone showing up. Look forward to seeing you next time.
Take care.